Hello, everyone. Good afternoon for those of you on the East Coast, and good morning to my West Coasters. Thank you so much for joining us today. This is Hillary Wicks speaking. I am the Marketing and Communications Coordinator for America Outdoors, and I'm just so happy to have you all with us today. Welcome to the first of our fall webinar series. We had a lot of fun introducing you to webinars this spring, and we had 5 really successful webinars, so we're excited to do it again this fall. We do have 3 more webinars scheduled this fall. We have how to use video to increase bookings, that's October 10th. Maximize your presence on TripAdvisor experiences, that's November 6th, and research, pitch, and land media on November 19th. So keep an eye out for those. You can also visit the America Outdoors website and click on events to see more of those. Another quick announcement before we get started, it is time to register for the AO conference. We have a really awesome program planned this year. We're really excited to be back in Salt Lake City. That's on December 9th. So just visit the America Outdoors website and click on the conference page to get more info about that and to get registered. All right, now let's talk about what we're going to be learning today. We are really excited to have Zeb Smith of Ascent Accounting and Consulting with us today. He's from Durango, Colorado, and he is a commercial member of America Outdoors, and they joined recently, and we're really excited about this because he really is kind of filling a gap in financial planning that we needed in the association. So he has a lot to teach our members about financial planning that he's going to share today. And so, excited to hear what your feedback is and kind of get going with that. Just so everyone knows, you should see a place where you can write in your questions in the comment box. Go ahead and do that during the presentation, and just know that we will be answering those questions at the very end of the presentation. And you should see Zeb there on the screen, as well as a little PowerPoint slide. You can adjust that if you want to make the PowerPoints larger, and go ahead and do that. If you have any questions about how to do that, you can also write in. I'm going to go ahead and turn it over to Zeb. You are in really good hands, and I will also be here kind of moderating. So go ahead, take it away, Zeb.
Awesome. Thank you very much for the introduction, Hillary. Everybody, thank you for attending today. I'm super excited to be a part of this organization with the advocacy and all that you guys do with American Outdoors. A little bit about myself is, so I'm a CPA. I'm also an avid hiker, hunter, and runner. And I grew up in Gunnison, Colorado originally. So being from that part of the world, the outfitters and the outdoor activities was a very integral part of our economy. I also have a whole family of entrepreneurs. So I grew up in the small business environment, subject to like the entrepreneurship, and then also around a lot of outfitters. So as I've continued to grow and evolve in my career, after getting my license, I've really found appreciation in working for and working with a lot of outfitters, guides, tour guides, recreational experts, and all that. So some little photos of me just doing some hunting. We have my fiance and I here. We are expecting our first kiddo here in the middle of October. So we're preparing for that. We've also been out hunting most of September. So I've worked maybe like 4 or 5 days this month and managed to be able to hit this up with you guys right in the middle of the season. So I'll be piecing out tomorrow and going back out and trying to finish the season to grab an elk for the next year's meat supply. At any time, if you guys do have any questions, as Hillary was saying, please go ahead and write them in the question box, and then we'll go through those at the end. This subject, or this information on how we helped an outfitter generate an additional $131,000 in wealth is like super exciting to me. And I get really excited when I start talking about this kind of stuff. So if you do need me to slow down, please let her know, and she'll chime in as well, okay? So without further ado, a little bit of a background. So here we have the business owner. So this is David. We started work, or he purchased his business in 2013. Okay, he is a local guide here in Durango. We are able to service and work with anybody in this kind of capacity on a national basis, but this is just coincidentally somebody that we've worked with here locally. So with his business, he offers whitewater rafting, 4x4 tours, Jeep and Razor rentals, and like zip lines. So a very standard, all-encompassing rafting and tour guide type of gig. Prior to working and engaging kind of with this advisory initiative, his best year that he had was in 2016 with an operating net income of about $67,000. Okay. We started doing the bookkeeping with David in 2016. Some other things that go on is here in Durango, there's quite a few climate issues that we face. So in the more recent history, we've experienced things such as like the gold mine spill, which took place, Gold King mine spill, which took place in 2015. That had a big impact. This is the Animas River right here, which is what runs right through town. And it's probably one of the bigger tourism draws that we have next to the train, which is caught in this little photo here. But the water turned from this beautiful blue down to this orange, had a pretty big economic impact on his business as well as our local economy. We also had the 416 fire that took place last year in 2018. This started at the beginning of June, and really we never recovered it through the rest of the summer. A lot of the local economy is still trying to recover from it even today. In 2019, there has been a good turnaround, so we've seen some positive impacts, but those were two really big hits in just a short time period. Okay. So following that 2018 year, his business, and you'll be able to see this later on, actually took a couple big drops. And I said, look, dude, something's got to change. Like, we're doing all this bookkeeping stuff for you. I want you to step up, and I want you to take on some of these advisory initiatives and give them a try this next year. I gave him a little guarantee and was like, hey, if you don't find this to be beneficial, I'll reimburse you everything. But I really have a feeling that we're going to be able to turn some of these declines around and really even boost and have probably your best year yet. So we looked at 2019 and had a series of initiatives that took place. Okay, majority of these take place in the shoulder season in preparation of his river season, the summer busy season, which generally runs from the end of May to beginning part of September. Okay, so in those, we needed to build expectations. We looked at what his particular needs are. We looked at some historical trends that took place and identified and visualized a lot of the ebbs and flows of the business. From those, we built benchmarks, including like currently where his profitability metrics were, and set some new target metrics for him to be able to shoot for. Then there was an execution piece, which is where we get into the nitty-gritty details on like really looking at the mechanical side of the business, some cash management strategies, and some changes to operations. And then throughout the year, there's a monitoring effort that takes place, ultimately resulting in what has actually been his best season yet. Okay, so through this, I'm going to go ahead and show you, and we're going to walk through every single step of the way from where this started at the beginning of 2019, the shoulder season, through our initiatives, what took place, to currently today, and be able to show some numbers and some metrics on where he currently stands. Okay. So the first piece in building the expectations is looking at the needs. A little something else is like all of this and what we talked through today can absolutely be applied to you in your business. At the end of it, there's going to be a guide that I'll be able to give to you guys and to be able to show you that basically walks through all this. I know Hillary's read through it before. Most of the AO ladies there have too. And this is basically like everything that we talked through in the guide that you're able to download from our website. I'll show you that a little bit later on. But I highly encourage any of these pieces that we talk about today to go ahead and implement it in your business, because it'll only help, right? So I went to David and we asked, what are your particular needs? Well, a couple of the two glaring initiatives that we noticed were he needed to pay down a lot of debt accounts that had been accrued from the slower 2017 and 2018 years. That 2018 416 fire, big losses, incurred a high amount of debt. So that was the big initiative that we needed to really tackle. That was just kind of glaring. The other thing that he wanted to do is to stabilize owner pay, to be able to set funds aside that he could then draw on throughout the year to make it nice and stable through the course of the year, to where it wasn't just gangbuster during season, slower during the slow season, right? So the next piece after we figured out what those needs were, is we wanted to look at historically what were some trends that we noted within the business, right? What we have here is, this is something that we build for all of our clientele. It's called a quarterly health report, and that we actually export the last 5 years worth of business, or 5 years worth of activity. And this is a heat map up here that, as we see darker green, it means good. So there's growth, usually in this case, like inclines and assets, and some, we can kind of see those ebbs and flows of the sales. But then darker red means bad. So then that's that increase in debt over that time, okay? We also were able to visualize the ebbs and flows of the business when it comes to the sales, okay, that we have here. So that second quarter of each year and the third quarter of each year, there's a lot of consistent increases, right? So those are like those big seasons. There's some good positive increases that are going year by year here. And then unfortunately, there's that decline that took place in the 2018 with the 416 fire. We also then see some operating net income. So this is the sales less the expenses. This is essentially the retention that takes place at the end of each quarter. So we have a lot of consistent patterns here. There was this big declines in that fourth quarter of each year. That was something that was concerning. We looked into that with a little bit more detail as to why. And also the other big key thing is the cash balances. Okay. So more in these, more intimately, so because we had a real big initiative going on knowing that things just needed to change this next year, these are actual notes that took place from one of our meetings. As you can tell, they're real fancy and just really kind of simple. I'm just kidding, fancy. But what we've looked at is, in this case, there was like the quarterly for the last year, and we looked at that big key season and captured some like current metrics on like cost of goods sold, gross profit margin. We noticed here that fourth quarter in 2018, there was still a lot of big incurred expenses, even though they slowed down a lot and there really wasn't much of a need for any activity in that fourth quarter, to where it was like, okay, we need to turn those operations off effectively ASAP once those sales start dropping off, right? So these are just comments and notes to really kind of establish kind of the benchmarks and those current kind of starting points. Okay, so in this accord, we just finished up the first quarter of 2019, or we were partway into it, and we were starting to talk about what we need to do for 2019, okay, or for second quarter of 19, which is his biggest year, or biggest quarter of the year. For net income, he's wanting to hit 200 grand in sales. We were looking to maintain a operating effectiveness percentage margin at like 28 or 80 grand in cost of goods sold, 120 gross profit, net operating income of 45K. We could use in that course, if he did that, there was about a $5,800 increase in improvement. Again, just kind of real loosely, kind of just trying to plan for the future. Based on that discussion, what we anticipated for the year to take place is that he'd have 500,000 in sales, about 100,000 net operating income, and should he make that, that was going to be about 40 grand better than his historical best year. And that would sustain what his cash requirements needed to be able to pay down the debt plus some. So that was part of that big first initiative of really paying down the debt that had incurred, right? So this was the start of looking at those target initiatives on what his needs were. Another component that we looked at too was super high level based on that 2018 year, where particular profitability percentages were at, owners paid percentages of sales, and tax percentages of sales. In his particular business right here, that 250 to 500,000 mark, this is what he would anticipate for being a healthy business. He'd anticipate to be about 10% in profit, 35% of those sales would go to his compensation, 15% would be retained for tax, and 40% would be spent in operating expenses. What we saw in 2018, however, was that his owner pay, or his operating expenses, were way over what his actual sales were. And here's the detail of it. It was a lot of long-term debt and current loan balances, and then those operating expenses, right? So he was not in very healthy shape. Those target percentages that we were going for right here, and these are about how much we needed to change expenses and that cash impact. So the biggest one being an overall decrease in operating expenses. We know that that's not going to take place overnight. So there's little tiny shifts that take place, and there's little tiny things we can do to then really key in on like the bigger, heavy hitting initiatives, right? So this is where we really started to build that expectations and gave him something to shoot for what he could anticipate as like a healthy business owner. So now we get down into the execution side of it. We've already built the expectations, we've visualized some trends. We're now going to start getting into the nitty-gritty details and figuring out, okay, we need to save all this money. Where is it that we need to save it, right? So what we've done here is we do a transaction review in which we go through every single individual transaction for the last season. So from, I think this was January 1st of 18 through December 31st of 18, he went through individual lines, purchases, and identified whether they were reoccurring or not, meaning does he anticipate to spend money on that particular item again in the next year? Is that particular item profit driving? Does it help increase his sales or decrease his expenses? Can it be replaced or negotiated? Is there a less expensive option that can basically satisfy what he's getting out of it that'd be replaced? Or when it comes to being renegotiated, is there a better option that's available and out there? A lot of these would be like professional services, right? So we as accountants and we as advisors are very much renegotiable in that like we can be, there can be services that are purchased that might be more relevant for the business, or we might have to like scale back if you're purchasing something that isn't being fully utilized, right? So it's making sure that those needs and the amount of money you're spending on a particular item match. Then the final big question ultimately with every individual item is, was it necessary or not? Okay. So based on that, we just use Excel and a pivot table to accumulate those items. And with him in particular, we saw that like Madwire right here was an item that kept kicking up as like 27,000 in savings. So like Madwire was his advertising agency. He was like, okay, that 27 grand, this was like the largest vendor that they had spent last year. Definitely something that could be renegotiated or replaced. Probably consider that wasn't necessary or not. And then from there, he could also like tackle some of these other items that we hired in green, or that we highlighted in green, to then go and like either cancel or renegotiate during the off season. Okay. But what this identified ultimately high level was about 70 grand in what he noted as like being unnecessary expenses. So that was just if he went and just canceled everything that was in that unnecessary column right there, he could instantly save like 70 grand, right? In theory. So the other piece that was then implemented were some cash management strategies. There's a theory out there about setting up different bank accounts and using those different bank accounts for different purposes. What we do is items get deposited into the income account, and then on a regular basis, they get transferred to the profit, tax, owner pay, and operating expense account. Ultimately, what that does is it reduces the opportunity and the ability for items to be spent in this operating expense account. Generally, if there's one bank account, which is what was being used before, you just have all your money being deposited into it and all your money goes out of it. Well, you see like 200 grand sitting in this bank account and you're like, woohoo, cash is good. We've got all the money in the world. Let's just go out and spend. That's very common. One of these things that we see, especially with like seasonal businesses, is you go gangbuster during that busy season, bank accounts get really high, we get excited, and we want to go buy new equipment, we want to go buy new rafts, we want to get gear, because there are big cash balances, there's a tendency to spend, right? So by applying and transferring money out of that one bank account into other accounts, we're then able to create like a savings for the profit, for the tax account, especially since we are anticipating his operating income to double, hopefully, or more this year. There's naturally going to be an increase in his taxable income, so we want to make sure that there's a reserve for it. And then also his other initiative was the owner comp, that he wanted to be able to have consistent owner pay throughout the course of the entire year. So the creation of those bank accounts and regular transfers between them naturally limits the ability for that operating expense account to just be one bank account with a smaller balance. And naturally, because it's a smaller balance, there's less inclination to buy, right? So that's what limits the ability to then spend. We did some structured spending habits, or structured spending, paying bills only 2 times per week, to only spend from the operating account itself. Also, there was an elimination of credit cards. So there were a number of credit cards that were out there, primarily because you wanted to build and accrue points, right? For travel, we all want to do that. A great way to be able to reduce kind of those other personal costs elsewhere, because you can like build these points out, but it's not really in line with what this initiative is. So we wanted to remove it. So it was like this year in particular, we're going to cut up those credit cards and we're just going to start spending within what we can afford, right? Also, he had a number of team members. So he has like a manager and he had some of those other like lead guides that had credit cards who were able to go out and purchase items during the season. We reduced the number of credit cards that were out there down to just him, or purchase cards down to just him and his manager, right? Also, his manager used to not have to report to him when it came to his spending, and that changed this year too, to where anytime the manager needed to go purchase something, he would run it by David first and Dave would give him the okay, right? So there was always kind of like a knowledge on what was being purchased if there was an emergency fund, if there was an emergency need. So then there were paying the recurring bills only twice per week instead of doing that every day. He'd sit down and go through them, or 2 times, per month, every other week, to be able to pay those bills. So he'd see what his bank account was, pay down the bills to an uncomfortable amount, or to a comfortable amount to where it got low. And then at that point, if there was no money in the operating expense account, or it was getting down to that minimum balance requirement that we had set, he'd have to then like call up vendors and be like, hey, I got to postpone this payment, or we got to cancel services because you're like the least important in our line and we're really not necessarily needing you, right? So a lot of those subscriptions were canceled in real time rather than canceled after the season. And then ultimately, there's really a need to stick to it. If there's no money in that operating expense account, or you've hit that minimum balance, you simply just don't spend it. And there's always an instinctive nature to want to steal from these other accounts, because the profit, the tax, and the owner pay accounts, those really start to climb, especially in these seasonal nature businesses. They climb really fast. There's going to be a want. There's usually a want to like buy new boats or buy gear, and you just can't do it. If you steal from the owner pay account, you're not doing yourself any justice as an owner. If you steal from the tax account, well, it's not good to steal from the tax people. You're going to have to end up paying that obligation somewhere else. Don't do it. And then the profit account, you want to retain those for owner distributions and for intentional investments a little bit later on, or to be able to really buffer up what that cash balance is in case if something like the 416 fire happens again. Okay. So that's kind of the mechanism, like the cash management strategies that he had implemented as well. Then there were also changes to operation that took place. The first one was a lot more of a team involvement type of incorporation. So he included his team in those savings initiatives. There were a number of games that they had created, or like just kind of fun little initiatives on being able to continue to use the equipment that they currently had. They had also set in-house goals as to what those sales requirements were. He looked at that Mavwire group and decided that they were going to go ahead and just cancel that this year and see what they could do in-house. And instead of it just being up to him as the owner, or up to him as the owner and a third party, he used it as like a team-wide incorporated like sales growth kind of thing. That gave them a lot of excitement and a lot of ambition. They also better understood kind of like more holistically like what the business was trying to do. And they were able to like, again, create some games and kind of have a lot of fun with it, right? So they set some in-house sales goals. During the preseason, he went through and renegotiated with those vendors, set up the tighten spending initiatives, also looked at the difference of leasing and purchasing vehicles. This was something that David came up with that actually worked out really well for him. Is instead of buying a new vehicle or a new fleet of vehicles for this year, he actually looked to lease out particular ones. Since there's a shorter season, he just had to pay the lease costs as well as any of that maintenance on that short-term lease versus the ownership of the asset, which is a lot of property taxes, the debt payments associated with it, the regular maintenance throughout the year. So that was something that was implemented as well. Then during the season, there was a timing of onboarding and offboarding employees. So historically what had been done is they would train up early in the season, and then he'd maintain a full staff basically through that whole season, where it was one team that came in. Rather than that, they'd do the trainings as a team, and then they would then the people that were trained, they'd go through their RAF training classes, the onboarding, that kind of stuff, but then they wouldn't actually bring people onto staff and start guiding until the sales were up, right? So they all trained together, portion of them dropped off and then came back on when the season came up. And then as the season started to taper off, instead of maintaining that full staff all the way through to the end of the season, the number of employees would taper down. It actually works out really well with like college students, right? So college students get out of school and they got to go to school. So that kind of natural of growth and progression of building up staff and declining staff really works with who his team members were. The other thing he looked at was number of runs per day. So before 2019, he would do 3 river runs a day going down the Animas River. And he looked at actually reducing that down to 2. So by reducing it from 3 to 2 runs per day, he was able to better load up his boats, bigger boat runs. Also, He didn't have to pay the number of guides as needed compared to like years past. And then his manager, who did all the busing, could then better apply his efforts elsewhere instead of doing like 3 trips throughout the day, right? So he's able to better utilize his manager's efforts. Also reducing the number of gas expense costs and a whole bunch of stuff by doing that. So he's becoming a lot more effective with the operations. The other thing is then closely monitored that advertising spending and then the return on those spendings. So we got rid of Madwire, did some in-house goals, but they really started looking at like the Google cost price per click ads, what the return of those were, looking at the Facebook ads, really starting to target the markets there, and regularly monitoring what the return on what those investments were. So there was a lot of close monitoring throughout the season there. And then in the postseason, so that's where we're at right now, evaluating the results, reflecting on where those goals are at, and then planning again for next season. So that what we're currently working on today. So the fourth component to it then is the monitoring component, okay? So we did the setup, we set expectations, we execute by doing a savings initiative, by changing operations. We're going through the season. Now we need to do some regular check-ins. We need to make sure and see if the business is actually in line with what those expectations are. Okay, so we send out a quarterly health report. This one went out on beginning of July, just following that fourth quarter. We do a visual trend type of analysis similar to what you saw before. Also have some things to note. So talking about paying down those debt balances, keeping lean on expenses and maintaining operating effectiveness, right? So just reiterating a lot of where those goals are at and reflecting on how things are. So in that, there was an email earlier that went out in May that we actually, I said below is a high level assessment of what I see. You're doing better than expected, but be wary. Don't let the spending bug get the best of you. This is where we saw those costs of goods sold and the gross profit margins were actually better than expectations and a heck of a lot better than they were that month of the last year, okay? So that was like really where things started off and really set the tone and got that traction going that can carry them throughout the rest of the year. Then at the end of July, this was an email I got from him. Maybe it was even the beginning of August, but he just said they just passed the top line sales from 2017. So he was like super stoked about that. And that gave me all kinds of good feelings on the inside because I knew that they were working really, really hard. So ultimately, what it ended up resulting to was his best season yet. Here's the financial impact. So there's the 2016 operating net income, which is that best year that he had prior to us going through these initiatives. The declines that we saw in 2017, the big hit in 2018 from the 416 fire, and then where we stand at today with that 2019 initiative. So based on what they changed and the team involvement and everything else, is he just blew expectations out of the water, giving him the ability to then pay down all those debts that he had incurred, to set up that stable owner pay all year long, which was his other big goal that he wanted. On a life impact, it improved his own morale as well as the employee morale. He has better employee buy-in throughout the season. There are a lot less issues with kind of just employee volatility. There's also much clearer expectations for the future on what he can anticipate for next year, as well as like expectations with the employees. On an emotional level, he feels awesome and he's just less stressed, right? So in summary, what did we end up doing? Well, we evaluated what his needs were. We performed a historical review to visualize trends and help anticipate the future. We then benchmarked based on past operations and set target metrics to shoot for. Through that execution component, we brought to light poor historical investments via the expense review, implemented cash management strategies to change behavior, and made time-sensitive and intentional changes to operations in real time. From there, there's a monitoring component on regular check-ins throughout the year and ultimately resulting in the best year yet. Okay. So questions?
Thank you, Zeb. We do have a question that came in the recreation industry, our industry, what is the typical labor cost percentage of revenue?
I will get back to you on that one. So it really all depends on the individual type of business, right? So like a hunting outfitter is going to be different from a river outfitter. Okay. So I'm super happy to answer that individually. The best way to go to is to do like a Google search. There's also a tool that we use that is more reporting, that if I have like your NAICS code, we can then look into what that individual like labor cost percentage looks like. So is there like any more particular industry?
It's river outfitters.
River. Okay. Yeah, so what I'll do is I'll actually give you that answer, Hillary, and you can put it in the notes to this a little bit later on, and then that way you can get it out to them. But yeah, just offhand, I don't know what it is.
Sure. Any other questions out there?
Okay. So here's my contact information. A good way to get a hold of me is zeb@ascentunlimited.com. That's my direct email address. Phone number is right here. Also, the website is, I was talking about that guide earlier. So here's Ultimate Guide, in which we actually talk about decision making, business planning. We go through like the specifics of those cash management strategies, and give an intro to record keeping, as well as some more case studies on exact or similar applications to like how these tactics have been adopted and implemented in other real-time situations, right? This cash-focused ratios and projections was a snowmobile guide tour that's up in the northern part of the country. So that was a fun and exciting way of looking at like receivables and payables and timing thereof to kind of boost what his needed cash balances were. And where you can get that is if you go to the website, ascentunlimited.com. You can go over to free resources and then download the guide right there. So.
All right, I do have a couple other questions that came in. Did you get any like good data on what the results were from eliminating the outsourced marketing budget, and if he's planning to do that again?
Yep, so right here. So here's basically like where that sales line was. So he was using the outsourced company, and that was generating, well, I mean, there's the economical downturn that took place in that. So he used that same company this year right here. The 416 fire took place, and that was the big hit. But when he eliminated that, there's where the boost took place. So, you know, from the best prior year to this year, there was a change of, what's that, like 50 grand basically, almost 60 grand. And by doing that in-house, David himself actually has like a local advertising kind of agency that he does like during the off season. So he was able to apply a lot more of his like knowledge with like the Google Analytics, and Facebook was the other one that they used. They did some really targeted marketing with Facebook on the the target audience is, and that's what he was able to gauge it. But I mean, right there, ultimately, just seeing that increase in sales from that 17-year up by eliminating it is, I think he's going to continue to do that again. He hasn't shown any interest in hiring them and just kind of continue this in-house because he broke that 500,000 sales mark that he was going for.
Awesome. How much has the use of credit been reduced in this case, and will it come back?
Right, yeah. So you mean the reduced in credit? So like the debt, and how much will that turn over?
That's a good question. Maybe the, not using the credit cards and not spending outside of what he currently has.
Yep. So, and see that question is very much like a behavioral thing. So, what we want to do is we wanted to set up a behavior on reducing the ability for spending to take place, right? So, after now that there's been this season and the behavior surrounding the spending habits, we can now introduce the credit cards again, but we'll probably be a little bit more restrictive on the ability for purchases to take place. So could even like put in caps on employee cards, or it can only reach a certain balance before it gets turned off kind of deal. So the behavior is what gets changed, and where we can see that really took grasp was right here, right? So in those years, even in this 2018 year that there wasn't that much volume, the spending was still like really high in comparison to the sales. But because of the change in the behavioral and the spending habits right there, look at this. This was at 222 of 368. This year it's been at 152 of 532. So there's where the positive implications come in. The difference of this, that 222 to 150, is about a $70,000 positive impact. And no credit card company would ever awarded close to 70 grand in perks based on like what they give out for using their credit cards versus that 70 grand in savings.
Great. I believe that's all the questions we have. So thank you so much, Zev. This has been really informative. And I will also include the link for people to get access to that full guide in the follow-up email, which will also have a recording of this webinar.
Okay. Yeah, no, Hillary, thank you very much. Thank you everybody who chimed in. Look forward to continue to work with American Outdoors. And yeah, thanks for having me online.
Have a good one, everyone. Thanks for joining.